You believed the promise, a steady guaranteed paycheck for life, rain or shine, market crash or boom. You thought annuities were the ultimate safety net, the bulletproof backbone of your retirement plan. And maybe for the first few years, that slow but sure check arriving every month felt comforting. But for millions of retirees, that reassurance has dissolved into regret. Too late to rewind the clock. What starts as the perfect hedge against market volatility can quickly morph into a source of hidden fees, suffocating lock-ins, and silent income erosion. Imagine discovering that the very product you trusted to protect your nest egg has been charging you up to 3% a year in embedded fees you never saw on your statement. Picture needing an unexpected $5,000 for a home repair or medical bill, and learning your annuity slaps you with a 7 to 10% surrender penalty, effectively punishing you for tapping your own money. Then there's the quiet killer of inflation, gnawing at that flat monthly payout until it buys less than half as much as it did on day one. And if your insurer's credit rating slips, or worse, they become insolvent, you could find yourself chasing promises that no longer exist with no FDIC backup to catch you. Even the death benefit you thought would pass to your heirs often vanishes or costs extra in rider fees, leaving your children with mere pennies on the dollar. Meanwhile, every dollar you withdraw gets taxed as ordinary income, sometimes at rates you never budgeted for. In this video, we'll peel back the curtain on 7 of the most agonizing pitfalls retirees encounter and show you exactly why the guaranteed income can feel more like a prison sentence. Stick around, because once you lock into the wrong annuity, changing course can be nearly impossible, and the regrets can last a lifetime. Annuities often come with a price tag far higher than you realize, and those hidden fees can quietly shave off significant portions of your income before you even see it. You might glance at your monthly statement and think, my annuity earned 3% this year, but what you don't see is the mortality and expense fee that chipped away at 1.25%, the administrative charge eating another 0.5%, and the rider cost, perhaps for a guaranteed lifetime withdrawal benefit, tacking on an extra 1% or more. Before you know it, almost half of your gross return has vanished into the insurance company's coffers. And these aren't optional extras you agreed to knowingly. They're built into the contract, buried in fine print, and often described in miles of legal jargon. Even financial advisors can overlook them because annuities don't list fees the way mutual funds do. That lack of transparency means you could be paying tens of thousands of dollars over a decade without ever realizing it. Those fees don't just reduce your immediate payout, they compound over time. If you thought you'd locked in a safe 4% return, you may end up with closer to 1.5 or 2% in real growth after fees, and that's before accounting for taxes and inflation. By then, the cushion you expected to buffer market downturns is paper thin, and your guaranteed income barely keeps pace with the cost of living. When you finally recognize the drag, it's often too late to switch. You're locked into surrender charges, and any attempt to trade into a lower fee product triggers penalties that make you think twice. That's why fees are the first regret retirees voice when they look back on their annuity purchase. A deal that sounded so secure turned out to be far more costly than advertised, draining the very nest egg it was supposed to protect. Lock-in surrender charges can feel less like a gentle handshake and more like a steel trap closing on your funds, locking you into an annuity for years and penalizing you harshly if you need access. Most annuity contracts impose a surrender period ranging from 5 to 10 years, during which any withdrawal beyond a small free withdrawal allowance, often just 10% of your accumulation, triggers penalties that start around 7% of the withdrawal amount and step down gradually to 0. Imagine this. You've been paying living expenses from your annuity for a couple of years when your roof springs a leak, or you face an unexpected medical expense. You turn to your annuity, only to learn that tapping $10,000 today will carry a penalty of $700 or more if you're still in the early years. That's money you needed for repairs, instantly vaporized in surrender fees. Even if you know surrender charges exist, you may underestimate how long they matter. Those step-down schedules can stretch out over a decade, meaning any change in circumstances during that window can cost you significantly. And suppose you thought you could ride out the penalties by moving to a new annuity with lower fees. In that case, you quickly find that a 7% surrender charge today, plus a new front-loaded commission and setup fees on the replacement contract, can result in double-digit losses before any real growth occurs. This dynamic traps retirees in products they can't escape, forcing painful choices between high-cost liquidity or waiting years for fees to fade. When you take the plunge into an annuity, surrender charges are the hidden chains that make guaranteed income feel more like a forced commitment. One so punitive that most retirees endure the penalties rather than tap their own money, often at the cost of delaying critical home repairs, medical treatments, or family support. Liquidity in retirement isn't just about convenience, it can be a matter of survival. Unlike a bank account where you can tap your savings at any moment, annuities often restrict access to principal, forcing you to rely on surrender schedules or limited withdrawal provisions. That lack of flexibility becomes a crisis when life throws a curveball, an emergency home repair, an unexpected medical bill, or even helping a grandchild through college. Try to withdraw more than your annual free withdrawal allowance, and you'll face crushing surrender penalties. Even tapping your allowable 10% can leave you stranded if the bill exceeds that amount, compelling you to scramble for cash elsewhere, drawing down other retirement accounts prematurely or taking out high-interest loans. Borrowing against your home equity might sound like a fallback, but reverse mortgages carry their own fees and complexities. Worse yet, the process of accessing your annuity funds can be painfully slow. Many insurers require notarized paperwork processing times, and even in-person visits just to initiate a withdrawal. By the time you get the funds, days or weeks may have passed, leaving you scrambling to meet payments or falling behind on critical expenses. That rigidity stands in stark contrast to the promise of guaranteed income. Ironically, the very product you bought to provide a reliable cash flow can dry up when you most need it. And studies show that retirees facing inflexible income streams are more likely to overspend on one hand or underfund urgent needs on the other, both scenarios that hasten the depletion of their overall nest egg and potentially force them to lean on family or sell assets at a loss. When you choose an annuity, recognize that access restrictions can turn your own money into a tightly sealed vault, leaving you perilously exposed in moments that demand immediate liquidity. A fixed monthly payout may sound like a fortress against market swings, but it's a poor shield against the slow burn of inflation, and over a decade or more, that erosion can leave you struggling to cover basic expenses. Imagine you locked in a $2,000 per month payment at age 65. At that level, you could afford groceries, utilities, and even occasional nights out. But with annual inflation averaging 3% by the time you reach 75, your $2,000 check only buys what $1,483 would have purchased a decade earlier. That gap widens every year. A single flat payment feels ever smaller as rent, medical bills, and everyday costs climb. Many annuity buyers assume they can add a cost of living adjustment rider to protect against inflation, but those riders often tack on extra fees, sometimes 1% or more of your principal annually, effectively canceling out much of the protection they promise. Without that rider, your purchasing power collapses silently. You don't see the difference until your bank statements show that your cash cushion isn't stretching as far as it used to. This isn't a remote scenario, it's the reality retirees face when they rely solely on fixed income. Meanwhile, other streams, like Social Security, may offer partial inflation adjustments, leaving your annuity lagging even further behind. Instead of viewing your annuity as a standalone income source, smart retirees blend guaranteed payments with investments or assets that can grow over time, stocks, real estate, or treasury inflation-protected securities that help offset rising costs. Ignoring inflation risk is like building a house on shifting sands. Your foundation seems solid until the tides come in and wash your security away. By recognizing that a guaranteed payment isn't the same as a protected payment, you can structure a more resilient retirement plan, one where your income stream keeps pace with the world, not the other way around. Annuities aren't bank accounts. They're contracts backed by insurance companies, and if your insurer's financial health falters, your guaranteed payments could vanish or be slashed without federal protection to catch you. Unlike FDIC-insured deposits, annuities depend entirely on the company's ability to honor its obligations decades into the future. Over the past 20 years, we've seen multiple carriers downgraded by ratings agencies due to investment losses, rising claims, or mismanagement, some even teetering on insolvency before state guarantee associations stepped in to cover a fraction of promised benefits, often capped at $250,000 or less. If you purchased a $300,000 annuity and the carrier becomes insolvent, you might recover only a portion of your principal, and your monthly checks could be reduced or delayed indefinitely. What makes this risk especially alarming is that financial strength ratings can shift without warning, driven by volatile bond portfolios, regulatory changes, or macroeconomic shocks. Retirees who lock into a single company annuity without diversification expose themselves to single-point failure. Even insurers with seemingly rock-solid track records aren't immune. The insurance business is cyclical, and prolonged low-interest rate environments can strain their reserves. And when a company loses its top ratings, savvy consumers often can't exit their contracts without crippling surrender penalties, leaving them trapped in agreements backed by a weakened balance sheet. To mitigate this danger, experts recommend spreading annuity purchases across multiple highly rated carriers, limiting exposure per company to the state guarantee association's maximum coverage, or considering annuity chaining strategies that stagger contract deadlines. But few retirees take these precautions, so when the unthinkable happens, they're left scrambling for income solutions while waiting on court proceedings or state assistance payouts that may take months, if not years, to materialize. In retirement, the solidity of your income is only as strong as the institution behind it, and choosing the wrong insurer can turn a promise of lifelong security into a precarious gamble. When you sign away your principal in exchange for lifetime payments, you often forfeit meaningful death benefits for your heirs, leaving them with little to show for the wealth you accumulated over decades. Most basic deferred annuities include only a return of premium death benefit, meaning if you pass away before breaking even on what you paid in, your beneficiary collects just the difference, often a fraction of what remains in your broader estate. Want a richer payout? You'll need to tack on a guaranteed minimum death benefit rider and brace yourself. Those riders can cost an extra 0.5 to 1.5% of your account value each year, further eroding your income. Even then, riders typically cap the benefit at a set date or percentage, so if markets swoon early in your contract or you live well past the break-even point, your heirs still lose out. And don't overlook surrender charge periods. If you die within that window, some contracts apply those same steep penalties to the death benefit, reducing the payout to almost nothing. Over 60% of retirees who buy annuities report surprise at how little their families actually receive, and that shock can turn into resentment when beneficiaries discover that a large chunk of their inheritance vanished under the guise of guaranteed contract terms. This hollowing of legacy hits especially hard when annuities are funded with inheritances or accounts meant to pass wealth to children and grandchildren. Your intent to provide a cushion becomes a story of lost opportunity. To avoid this pitfall, carefully review death benefit terms, compare rider costs versus potential payouts, and consider maintaining an unannuitized portion of your savings in vehicles that preserve full principal for your heirs. Remember, a truly secure retirement plan balances your lifetime income needs with the promise of a real legacy, not a hollow echo of the safety net you built. Tax-deferred growth in annuities sounds appealing, no taxes until you withdraw, but that deferral comes at a cost when those withdrawals hit your tax return as ordinary income, often at a higher rate than long-term capital gains or qualified dividends. Picture this: your Social Security and other retirement income already push you into the 22% tax bracket, but you've assumed annuity earnings would be taxed lightly because they grew tax-free. Instead, every dollar you take out is tacked on top of your other income and taxed at your full marginal rate, sometimes as high as 35 or even 37%, shrinking your net benefit significantly. That surprise can come at year's end. when you tally up W-2s and 1099 RS and find that your anticipated disposal income is suddenly much smaller after the IRS takes its share. Worse yet, many retirees forget to account for state income taxes on annuity distributions, which in some jurisdictions can eat another 5 to 10% off the top. The net effect is a double whammy. You lose growth to embedded fees, then lose more of your payouts to taxes at rates few had budgeted for. And it gets trickier with non-qualified annuities, where each withdrawal is treated as coming first from earnings taxable rather than principal non-taxable, maximizing your tax hit early on. Some retirees attempt to mitigate this by withdrawing only the exclusion ratio amount, but those calculations are complex and often misunderstood. One misstep, and you inadvertently trigger a full taxable distribution. The result is a year-end tax bill that can rival your worst working day nightmare. To optimize tax efficiency, you need a deliberate withdrawal strategy, perhaps blending withdrawals from Roth buckets, taxable accounts, and annuity distributions to manage your marginal rate. Without that, the tax-deferred allure of an annuity becomes an expensive trap that siphons off more dollars than you ever expected, ironically reducing the very security you thought you'd guaranteed for your retirement.